And now, ladies and gentlemen, we move on to the final panel discussion for today, self-insurance and risk retention, why, how, and when. This will be moderated by Yang Berbahagia, Dato Majid Mohamad. Dato Majid is the chairman of Etiqa Family Takaful and Etiqa General Takaful. He has extensive experience in the setting up, regulatory planning, and rehabilitation of a wide range of finance and insurance institutions in the industry. Starting out at Bank Negara Malaysia in 1977, he has held various supervisory roles across key departments from audit to economics and bank and insurance regulations. Joining him on the panel will be Abdul Halim Jantan, Director and Chief Executive Officer of Sterling Insurance Brokers, Azmi Abdullah, Group Treasurer, Genting Berhad and Principal Officer, GHR Risk Management, and Anthony Egerton, Principal Officer of Huntington Underwriting. Ladies and gentlemen, please welcome them with a round of applause.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh and good late evening. We are short of 50 minutes now. We had to start at 4:45, but now 5 o'clock. I have pressure from Halim because he wants to go for 9 hole at 6 o'clock. So I'm leaving me only for less than 1 hour to speak to. Talking about Dato, thank you very much for staying back because it's a graveyard shift, so to speak. But you are still around. Thank you very much. And talking about golf, since we cannot go into the golf course, we have to play virtual golf. Okay, so for that, I think we have to tee off first with the lowest handicap. There is Tony Egerton. I don't have to introduce Tony because he's a very well-known personality. He is, in fact, subject matter specialist with Labuan IBFC on captive. Has been going around a roadshow all over the country and also to the Asian country. What our job here is just to answer 3 questions. There is why, how, and when. That is not complete because journalists would know you have to answer 5W and 1H. So who, what, and where are missing. Maybe the organizer will do that next time around next year. Anyway, Tony, to cut the matter short, I would like to pose a question to you. Go to basic. Bear in mind, this is a practical session. We're not talking about MBA staff or textbook staff. We're not talking about. So that's why we have 3 practical practicing people on the stage today. Tony, unfortunately, you're coming so far away from Singapore. I got to pick on you first to talk about what I have to add. What here? What is the difference between self-insurance, risk retention, and non-insurance at all in the first place? Very briefly, and later on, you may want to give reason as to why corporations decide to embark on the self-insurance and captive. That is to answer the first question on why here. Tony, to you. I have to sit down because of the age, although the level of the age now is gone, the benchmark has gone up, I still old.
Dato Majid, thank you. Ladies and gentlemen, good evening. As Dato Majid was saying, this is supposed to be the practical session where we talk about sort of where and why and how. Why are we going to do this? How are we going to do it? And when? And Majid's asked me to sort of start off with sort of what do we mean? What are we talking about here? Okay, and I think the first thing we have to recognize is there's a huge difference between non-insurance and self-insurance. Okay, let's be entirely clear what we mean by self-insurance. Self-insurance is not non-insurance. Non-insurance is not identifying a risk, retaining that risk, and ultimately reaping the reward or not of retaining that risk, but in total ignorance. All right, so we are talking about a conscious strategy of self-insurance, okay, where an organization decides that it is exposed to key risks in its business, in its activities, in its footprint that it chooses to do something about. That may do many, many things with those risks. One of the historical sort of simple solutions to that is go and buy some insurance. Okay, but we're not talking about that. We're talking about self-insurance, a conscious act of retaining risk. So first of all, you've got to have identified the fact that those risks exist. You should have gone through some formal enterprise risk management process in identifying and quantifying that risk, and then deciding with your key stakeholders in the business how much of that risk we're willing to self-insure. Okay? I mean, sorry to start with some basics, but that's why we've got to be quite clear what we're talking about. All right, ladies and gentlemen. So when we're talking about self-insurance, and we've gone through that process, and by the way, it sounds pretty simple, but in fact to do properly is a very, very complex exercise. Most organizations don't have the skill sets internally to do that, to be frank, particularly if it's their first time of doing it. It does require external support and assistance, I would humbly suggest, to many of you and your organizations. But when we decided that there is an element of the risk that the organization is willing to retain, the question then becomes, how are we going to retain that? No. We can just sort of this is not non-insurance, don't forget, this is self-insurance. We've identified, we've quantified, we've decided that this is a risk that in aggregate the organization's willing to self-insure. Well, we'll just run it. We just don't need to buy any insurance. We don't need to incur the premium expense. We can do that. All right? That's one answer to the self-insurance question. At the other extreme, of course, we have these things called captives that we're talking about over the last day and tomorrow morning. Captives have become, to be honest, I saw a slide which referred to captives as alternative risk transfer. Frankly, ladies and gentlemen, captives are not alternative risk transfer. They are mainstream risk management tools that are used the world over. 6,500 of them, apparently, and that's excluding these cell things that we're going to hear more about tomorrow. So this is nothing new. This has been around for decades. They're a very standard risk management tool, and clearly they are an option, a different option to self-insurance in terms of retaining risk on balance sheet. There are variants of these things, and once again, so we're going to hear some more about them tomorrow, protected cells. But I think we should, in terms of discussion today, focus on the difference between self-insurance and captives.
Okay, Tony, get back to why certain corporations decide to go through different route into self-insurance, if you may. Well, the reason, that's why I want to answer why.
Okay, sorry. So let's say why. Well, to be frank, insurance is an expense to your business. Okay? There is no need for many organizations to buy the full extent of insurances that they buy today. Yeah. Many organizations have balance sheets, have stable, non-volatile cash flows that would allow them to retain a significant proportion of what they have historically insured. There's no reason to incur the expenditure if there is a risk retention capacity and appetite within the organization.
Okay, Tony, thank you very much. You're talking about why. Now we want to go into the specific example of why corporations get into captive. Remember last year we have Tenaga Nasional, but today we have Genting. So please, Genting is not all about gambling, okay? You have a big project on top of the hill there. Later on you can bring your kids up there, But I don't want to steal the thunders for you, Azmi. Can you please explain why for 20 over years you've been, you're among the first to set up captive in Labuan? Why?
Good evening, everyone. Thank you for inviting me to become a panel member here. And basically, for Genting Group as a whole, we have been involved in the captive arrangements for the last close to 20 years, actually. One of the reasons, actually, we go and self-insure in some of our what we call properties. Is because it's also to impose a certain discipline on ourselves to inculcate some risk, because we involved in some risk management activities that we engage in. So we want to be rewarded for that also. But they also to save on the premiums that we would have gone out unnecessarily from the group. Dealing with the reinsurers, we would have a direct access to the reinsurers, their risk management practices directly, and we can engage with them actually in a better way. We are able to customize our risk management practices that would fit our requirements much better. Going back to when, close to 20 years ago, when we first set up our captive, in the late 90s, actually, our sums insured was getting larger and larger. It was such that actually, when you add the net retentions of all the insurers, actually, you know that actually that the market cannot take it. And the sums insured was getting larger. When we had to take action and as to how we will want to place our risks, and so we had to have greater control of our program, and not just place with an insurance company here, and they do the placements, and basically they tell you these are the risks, the what I call the insurers who you have placed it with, and so forth, and we don't really know. At that point in time, regulations was not really clear, actually, to us, actually, as to how they were insuring their risk our risk at that point in time. So there were some concerns in our program. We were dissatisfied with the price, the cover, and the service. We were dissatisfied with the security. We were dissatisfied with the way we manage our own risk. So we had to take some action, actually, to see how we can actually place our risks. But that's why we went into doing captive arrangements. In our captive, we maintain a certain level of deductible. The things that we look back at our what I call our losses over the last many years, and it's something that we know what we can stomach. But it also, by maintaining certain level of deductible, we then actually we have to protect that. We take action by involving ourselves in risk management activities in our properties. We engage with loss control surveyors to ensure that actually our deductible is protected, and that deductible that we maintain, actually it's something that we have to test the waters as to what the market is willing to reward us. So we had it was at one point in time, loss control was given very much a priority. We spend a lot of time on loss control and ensured that actually every month we spend time ensuring loss control is what I call implemented. The loss control recommendations is what I call when we engage in the risk management activities, those loss controls.
Yeah,
okay. those activities are taken care of in a very tight manner. So recommendations of simple things like paintings over sprinklers, adequacy of sprinklers and so forth, adequacy of hot works and so forth. So those are things which we attempted very much to ensure that actually our deductible is very much protected.
Yeah, I think it sounds like a cookbook, you know. I think you can talk to him later. I think he's writing a cookbook for you to be sold in the market. Well, let's move to Encik Halim before we go for a poll question. Halim, 5 minutes, or because I know you can just pull through. You are a karaoke singer, maybe you can bulldoze through. But being very experienced in the market, especially LSR, large and specialized risk, and I think you get involved in one of the utility company going into doing self-insurance, I'm sure there must be a reason, compelling reason for you to talk to this guy. I know you are very persuasive. To tell these big company, utility company, to go into self-insurance or rather captive. How do you convince them? What are the problems?
Thank you very much, Mr. Chairman. Maybe let's take ourselves back to a little bit of perspective. Keep it simple. All of us wants to go to 2 places when we manage our business: progress and innovation. So if we're looking at self-insurance, it's a journey towards progress and innovation. 20 years ago, Genting Berhad was just doing what Genting Berhad was doing. But along the way came the insurance broker, came the insurer, came the captive managers and everybody else telling him, that's not just the way to go about doing this. Perhaps you may want to innovate, move away from your traditional method of just insuring yourselves, believing in all the insurers in around here, you know, the AIGs of the world, the Allianz of the world, the Zurichs of the world. Time has come. You may want to take some control. That's the cookbook Azmi was trying to talk about. So to me, the way forward really is, if you're starting from a 5-man startup, ultimately, despite your automation and digitalization, you would want to think of how you want to manage your business better by innovating. So when we went to talk to our friends and our clients potentially to go the captive route, we wanted them to self-insure simply because they have more control. So when you self-insure, you actually have more control. One of the primary acceptance or the primary force in moving towards self-insurance, as Tony mentioned earlier, is risk management. That's the primary focus. It's not alternative risk transfer. You want to go into risk management. With risk management, you manage your risk better, your deductibles better, you manage your profitability and your bottom line better. So quick answer to why conglomerates must go down the route of self-insurance is really progress and innovation. Stop believing in everybody else. Believe in yourself. You can do it. You can risk manage. You manage your balance sheet better. That's profitability. I think we're talking about sustainability. That's the route we must take.
Very good, very concise. Can we stop for a while? Go to the poll question. Is it on there?
Slide over.
You know, I have to vote as well. I put all, correct, don't follow me. And send already. Okay, can we go to the next round? Tony, back to you. Since you are the lowest handicap, I got to go over you. Based on your experience, he's handicap single, he's single handicap, yeah. Based on your experience, how different structure of risk management or captive can suit different type of self-insurance? For example, particular what is advantage of PCC compared to on-balance sheet approach and risk retention strategy? Okay, different structures suit different risk appetite, for example.
Thank you for the question. I don't think it's so much different risk appetite. I think it's more to do with, to be frank, the expenses of the alternatives. You know, establishing a captive involves a series of steps, engagement with regulators, the putting aside of the capital. All of these incur costs, which are probably the greatest of all of those options you mentioned. Self-insurance, of course, is a relatively low cost, at least ab initio, up front, there is zero cost to self-insurance. The only question is whether or not the pure act of self-insurance generates some of the benefits that that Genting has done and others have done through using the vehicle of a captive or some other risk pooling entity as driving the whole risk management strategy. So Dato, I think it's more probably cost driven. Mm-hmm. Although having said that, to be frank, in Labuan, establishing a captive is given the low costs in that jurisdiction, given the relatively low levels of capitalization, at least initially. I don't think the cost of establishing a standalone captive from scratch greatly exceeds those of a PCC or other forms of structure. I would typically encourage a new prospective sort of captive owner or PCC owner to really go straight to a captive for themselves in somewhere like Labuan, because the costs are really very reasonable and affordable. As I think George was saying this morning, it's almost a case of why wouldn't you do one, have one on the shelf, ready to go? The question is when and how you use it as part of your risk management strategy. But given the relatively low cost, you should have one today, I believe.
Okay, Tony, I know Labuan was always promoting themselves as a low-cost jurisdiction for whatever a company or business and insurance. But I'm going into a question that posed there. It's not there in my iPad here. Based on statistics presented, you know, the number of new setup is not that encouraging in Labuan compared to other domiciles, especially in the West and the Caribbean. Can you get some explanation as to reason and step to be taken? Tony, you are very closely associated with FARA and Labuan FSA. I'm sure you got the answer.
Well, I don't know if I have any answer, but I usually am willing to have a go. I mean, clearly the established captive centers like Bermuda and the Caribbean are an obvious choice, particularly for North American and indeed Western European corporations. And many of the early captive owners in Asia went to those traditional captive domiciles. That is changing. It isn't changing perhaps as fast as some of us would like, and we believe should be changing, but it is certainly changing. Some of the tax drivers that the previous panel were talking about, and the need for substance, and the need for real activities taking place in your domicile, the need to future-proof your captive, I think will be a big driver for corporations to focus on, you know, really easily accessible domiciles. So I think that will change things. I do also think, just as an aside though, the fact that Asian conglomerates in places like the Philippines, Indonesia, and elsewhere have had insurance companies within their groups for decades. Yeah. Does mean that when we're talking to conglomerates in this region, they say, well, I've already got an insurance company, I've already got a captive. Now, of course, that's been operating as a standalone insurer, albeit benefiting from the captive business of the group, onshore for decades. You know, and that is one of the reasons why another reason why there's a slow take-up here is because captives in Asia, many of them have been here. We haven't recognized them as a Western-type captive, but they're just as much a captive as anybody else. They actually write a preponderance of third-party business, which we wouldn't normally recommend a captive to do. So we do have to realize that things are changing. Certainly these changes in the tax environment will mean that things will change faster, but we also have to recognize that the landscape here is different today, historically, and in the future.
Okay, Tony, one question again. You've been following the roadshows of Labuan FBFC to many parts of Asia, especially in Japan. and there's a surge in the interest of Japanese to open captive in Labuan. Can you explain the reasons for that, and what are the interests in Labuan that really attract them?
Well, once again, tax shouldn't drive your captive strategy, all right? Let's be entirely clear about that, all right? Anybody who believes otherwise is destined to fail and end up in court with their tax authority, okay? So just be entirely clear about that. At the end of the day, why is tax a driver, okay? Just remember that tax is important because we want the insurance premium to be a deductible expense for the host organization, all right? And the profits that the captive earns offshore, we want to be taxed in the domicile, okay? So that's why tax is important, but it's not the be-all and end-all of captives. Please remember that, all right?
Yeah.
Now, with that health warning, I'll now talk about tax. And substance. The reason I think, and there are people who know much more about this than me, and most things than me. Anyway, the reason why Labuan is much more of an interest today than it has been historically compared with some other, which we won't mention, captive domiciles is exactly substance. The fact is we have in Labuan I think most of what we'll need for the future. I'm not saying that everything is future-proofed, but we have just about everything, and the rest that we don't have today that it will transpire we need, we can put in place relatively quickly. Some of these other domiciles that have been just a captive domicile, I'm sorry, they will not have a future.
Okay, Tony,
That's why.
You can have your drink now. Just one question here. I think it's more relevant to Halim here. At the moment, only a handful of government-linked companies, GLCs, have set up captive in Labuan. What are steps taken, either by regulator or by industry or by the company itself, to convince the other GLCs to consider and eventually set up their own captive in Labuan? Please.
Thank you, Dato Majid. Perhaps the GLCs in Malaysia are too busy doing many other things instead of looking at really bottom line. That's one reason. Reason number two is a question of acceptance. It's only very recently that in Kuala Lumpur that we've been able to push the position of risk officer to be in the C-suites. First step. Once we've got the C-suites guys, from risk management into the C-suites, then the daunting task of having to explain what we call the total cost of risk, for some of you as insurance practitioners, you know that, really is like an iceberg concept, writing an insurance program. The top premiums that you pay is just what you see, but what goes down beneath the line is huge supply chain risk and supply chain services that exist. The brokers thrive in it, the captive managers thrive in it, the insurers thrive in it. All these needs explaining to the boss. So if you're just a lowly risk manager, having to explain to not just your general manager, but your chief executive officer, who's only got 5 minutes of his time for you, Mr. GLC, if you're out there, please spend a bit more time with your risk managers. You are not. I can see this in Malaysia because we've been seeing them again and again and again. And most GLCs in Malaysia, Dato, this is something that I think we've got to change. Most GLCs have got gatekeepers. And these gatekeepers are the ones who are really, Dr. Sun Yat-sen had a lot of difficulties in trying to remove feudalism. We still have feudalism in our GLCs. We got tigers on the hill, guys who wants to be there for the right reason, but perhaps doing the wrong thing. That's what we've got to change. So we've done the first step. We've got CROs now, and CROs now must be given the ability to engage with the market. So hence, I'm not so sure because of the convergence of just not the millennials, which is causing people to be in love with the screens. I'm too now. I look at the screens all the time. My kids does. Because you're in love with the screens, you forget that there's people out there. So therefore, your engagement with the market becomes also very, very important. Perhaps in some of the GLCs, if you can spend a bit more time in networking with the market, your insurers, your brokers, your adjusters, your captive managers, they're your friends. Because when you've got to pull this act together and explain to your boss why you should go to the self-retention group and create a position for yourself and create substance in the group that you want to develop, you're going to need the assistance from everybody. And that's where the failure is today. A lot of GLCs are not going there because the C-suites doesn't see insurance ultimately as a tool for proper risk management, which can be converted back to sustainable profits. They see insurance as just an expense that's got to be dealt with just like everything else, like buying exercise books and like buying everything else. That's where the difference must come in. So I think way forward for all GLCs, based on the knowledge that we've seen and exercised in Malaysia, we need to have a lot more competency in the insurance division. So I'm not just saying this for the sake of starting out body shopping for all our insurance friends to get a job in GLCs, but that's where it has to start first. And to this, there's a lot of intellectual capital in the market already, Dato, to be able to push this forward. Just a question of where you see yourself in this journey of progress and innovation. Just 1 minute before we go, in the same exercise that we took for this particular GLC, which is a utility in Malaysia, the CRO actually saw this as a journey, and he calls himself as a paranoid manager, which I thought was good. But where he started, which was even better, is he says, Halim, why is it that the bank managers, everybody wants to see them, but as an insurance manager, nobody wants to see me? So it's a question if your risk is not good. So that's where he started. He recognized that he needed to have more control. He realized that he needed to have a lot more predictive and perhaps even to some extent objective modeling for his own purpose to be able to get to where he wants to be. So in the first instance, he decided, okay, let's have a 5 years journey, and at the end of the day, I want to be a preferred insured. To be a preferred insured where all the insurance companies are going to chase me is I go through a process and a journey of risk management. That's control. So that's what he did. So 5 years down the road, today we are applying to the authorities for them to be a captive. Now that also will tackle the BEPS in OECD's mind. If you're talking about substance, to me that's substance. If you're talking just going into the PCC route, that's not substance. You want to be able to start somewhere, and with a CRO being perhaps the chief executive officer like him in the captive. So for him, it was a journey that is going to create innovation, that's going to create substance, that's also going to create profitability. At some point in time, people must understand it's just not about the insurers. It's also about the client too.
Okay, a good takeaways about C-suite, about gatekeeper. Can you please leave within this room? Huh? Don't get out of the door. Anyway.
Mr. Chairman.
Tony.
One small thing to add. A lot of GLCs, Malaysian GLCs, have captives, are captive. They just don't realize it. Your old company is owned by several major GLCs.
Yeah. Okay.
Now, that is, you could say that's a Malaysian version of a captive, but we've never thought about it as such, okay?
Risk management.
All right.
Sorry. Good, very good one. Okay, now, Tony, you were saying a tax shouldn't be a driving force. And some of the people also, profit should not be the ultimate reason for you to set up captive. But, Azmi, your captive has been making money all the year round, all the way around for the last 20 years. You know, how do you do that? Can you share the experience with new people that will come on board?
As I said in the past, earlier, that basically spent a lot of time on risk management. We engage a lot of it, basically engage loss control consultants who come over to our property to have a look at our property, basically. Then with all the recommendations that he makes, then we ensure that actually we will implement those loss control recommendations to make sure that we don't engage, we don't get into a situation where we have to make a claim, actually. Then as a result, we protect the whatever profits that we can whatever profits that we can make from the on the captive side. It's basically protecting the whole cost of risk, actually, to ensure that your cost of risk is minimized.
Okay. Okay, can we go to the next poll question? Yeah. Where is it? That is question from the floor, the poll one. Haven't done that. I should do now. Need improvement. Okay, son. Okay, now I would like to take some question which I think there's some question here. Yeah, it's a lot of question. I only have 40 minutes here. Okay, the first question, I think, I don't know whether Encik Halim can answer. The Islamic insurance, Takaful, has grown faster than the conventional counterparts in the last decade, especially in the Middle East and Malaysia. What steps have been taken by the authorities, you are not the authority, to promote the setting up of Islamic Takaful captive? I think Daniel Moy is not here, so you'd like to answer this? Just give some points.
I can try.
How do we?
Yeah, I can try. Let's compare them to the conventional captive.
Yeah.
Not much difference. But what's true is, yes, the Takaful businesses is actually overtaking the conventional businesses in Malaysia simply because of the convergence of the sukuk financing or the Islamic financing in Malaysia, and Malaysia wanting a hub to be the financial institutions and financial services to provide all this financing for Takaful businesses. Hence, you've got no choice, you go down the Takaful route. But starting out a Takaful captive, I think, like Tony says, Labuan IFC has already got a fantastic infrastructure. There's nothing that needs to change. If at all that we need to change, just like the conventional insurances, is to change the concept from just civil laws to adapt the Islamic laws, Dato. And I think everything else can stay, because the infrastructure is the same. The concept is the same, the methodology is the same. Beyond that, I think it's the authorities that should come forward and say what else they want to do to encourage. Beyond that, tax is only 20,000 or whatever it is, that's higher or lower. In the case, you pay just 20,000, right?
There'll be a change on that.
Real change.
Yeah. So if it's going to change, that's perhaps one area we've got to look at. But the other area, as a practitioner, if I can guide the authority, whilst we want to talk about substance, we want to talk about capabilities. We want to talk about rewarding organizations or captive companies or conglomerates that goes down the route of risk management to be rewarded properly. Of course, the reward here must come from the insurance market. But if the authorities can actually guide that reward that's being given back for risk management, I think that's the key to success and sustainability of all insurances. Hence, Mr. Authorities, if you're on the floor, if you're setting up, you want to consider rewarding risk management a lot more. In my opinion, that's going to be a kicker.
In the larger space, you're talking about captive, about reinsurance per se. Do you see Labuan as center? This is what Raymond trying to develop. Move
Yes, sir.
all the reinsurance from onshore to Labuan so that we can set up Labuan as a reinsurance or Takaful center. What say you?
I
You are
think
the
we
main
should.
player onshore,
Yeah.
but now you're talking offshore now, Labuan.
I think we
Proceed.
should, but to accommodate that, perhaps we have two problems. Infrastructure is not the problem. The problem is acceptance. If we model ourselves again Bermuda, for example, the standards and the structure that Bermuda has with Labuan doesn't differ. But Bermuda went forward and benefited a lot more with alternative capital. The alternative capital came with a lot more progressive and innovative thinking by the insurers. In fact, in our regions, there's already a lot of alternative capital, but it's not going to Labuan. That perhaps the authority may have to figure out. But I think setting up a reinsurance sort of facility and structure in Labuan, Raymond has just got to do a lot more.
Yeah.
And Raymond is just...
Raymond is there.
Yeah, Raymond is just 60 years old.
You have another
right?
2 years to go.
Yeah, he's got 30 over years to go.
Yeah. Sorry. Yeah. No.
30 years to go. But perhaps as a friend to Raymond as well, it is also the role of people like us, brokers, who then can provide alternative solutions. Because some of us, I hear very clearly from Razia just now, she said that, to some extent, whilst we've got a one-stop broker, all the big guys, we've also got the little guys who has got niche knowledge and in specific areas. So these solutions can also be brought together. Now, what I am not saying, really as a broker in Malaysia, is if a broker goes out and fix a particular account, that the insurers will gravitate and work particularly with one common order. I.e., say if I'm given the letter of appointment, there will always be other insurers who will form cartels in the hope that that particular letter of appointment can be made void by better solutions. Now, if the solutions benefit the clients and the market, I think that it makes sense. And as we speak today, sometimes the solution only benefits the clients. It doesn't benefit the industry as a whole. It doesn't benefit even Labuan. So perhaps we as a player, including with my friendly insurers out there, when we go out and provide solutions, we got to think of Raymond too. I.e., we set up, then we can. Because individually, Raymond can't do this. I'm not sure he can live beyond 100 years. I believe he can. But even then, to do this alone would be impossible. So really, Dato, what we need is an industry initiative. But whilst we need an industry initiative, we need the captains of industries to actually come forward and draw this master plan together. If we don't, then we risk Labuan. I have seen it where we start out solutions for conglomerates and all that. What is it that we want to provide to the conglomerates? The most comprehensive cover, but also the cheapest premiums. That may not go down well for the sustainability and the future. We may want to consider rewarding risk management, hence providing a lot more competitive approach for innovation to take place. If I say any more, some insurers will get upset with me and my
Okay, you
broker
better
friends
stop
too.
there. Tony, you have anything? Yeah.
Well, just a couple of things to add, Halim. I mean, clearly, well, I don't know how realistic it is to move the Tier 1 capital, reinsurance capital, to Labuan, realistically, to be frank.
Realistically, no.
It will be interesting to watch. What is already today happening in Labuan is real alternative risk transfer, all right? Oliver, Schofield, and Principal Re, they're a broker. That's all they do. I'm now going to blow my own trumpet, so Huntington Underwriting, all we do is structured reinsurance solutions. That's all we do, okay? We have some of the latest technology anywhere in the world available in Labuan, all right? So clearly we have a way to go to have ILS capital and a framework for that, but I know it's being discussed, all right? But in all other respects, we have everything and anything that's required, all right?
Okay, now, one question that coming out online, I think Tony, maybe Halim can say, when will soft market end to prepare for captive rules? But I remember this evening, I heard that the soft market is a new normal. Okay, so when those GLCs that are waiting for the hard market, sorry, sir, okay? So in this situation where the soft market is a new normal, when? So we have to answer that when is the appropriate or suitable time to set up captive? Tony?
Well, I think that anybody that believes they can time a market, any market, is deluding themselves, okay? Anybody that thinks they can buy at the bottom of the stock market and sell at the top, well, I'm sorry, they must be, well, anyway, let's not go there. So I don't think that I don't think you should seek to time a soft market and a hard market. I mean, I think it was Malcolm this morning was talking that in fact, or somebody else was talking that in fact, apparently counterintuitively, more captives are set up in a soft market than a hard market. I don't think it's relevant, to be frank. What is relevant, as George was saying, is this is a tool. This is not alternative. This is mainstream. If your organization is of a certain size and sophistication, you need one. Now, how much you use it, how much you retain in it today relative to tomorrow, relative to the state of the market, that's more tactical, But strategy-wise, it's almost a no-brainer. You know, we're waiting for the end of a soft market. I'm sorry, someone's deluding themselves. With all due respect to Anonymous.
Let me take it from
Okay,
there.
yeah,
Dato.
Halim, yeah. Go ahead.
Soft market, irrelevant. From my point of view, there's no soft market, there's no hard market for captive. If the conglomerates are ready when your risk management regime at its highest, that's when you should get in. So if you're not today, you're still having these losses and you don't know why these losses are coming from, you're not ready, regardless if it's a soft market or hard market. So in order to determine soft and hard market, it's your role too. Hence, you want to take control. So I always believe captive being a mainstream tool is when you are ready to do it, when your mindset is ready. First thing first, sack all your risk manager, replace it with a chief risk officer. If he or she is good enough, promote him or her. Step number one. Then get down into risk management. It takes usually 2, 3, 5 years, but you're on the journey. So, Dato, soft market irrelevant when you form a captive. What's relevant is control as well as risk management regime. You become a preferred insured, then captive is ready for you.
Good. Another question there. I think we have answered this on the tax saving. I think, Tony, you tackled this. It's not the main driver for that. Is it there? Yeah, it's not the main driver. Sorry. Yeah. I only have 3 minutes left because I'm very disciplined, okay? Yeah. You have 3 minutes, mean 3 minutes. Anybody has got a last say before we close the session? Especially Azmi, you need any advice from the guru to all those people that would like to embark on this journey?
As Tony and Halim had said, actually risk management is the prime motivation for setting up the captive. If you're not ready on risk management, you're not taking enough discipline to ensure that a culture is in place on risk management, you're not ready for a captive.
Okay. Halim?
Key
1 minute.
takeaway, innovate. Stop going the traditional route. Time for you to rethink that insurance is important enough. Insurance is a big way forward. Captive ultimately is your preferred choice.
Thank you. Tony, you have 2 minutes, no? Please.
I think I've spoken enough.
No.
The risk manager, you know, at the end of the day, I think has provided the greatest insight. It is, at the end of the day, a risk management tool that needs to be embraced, needs to be part of a much broader strategy. You really need to commit as an organization. You as the chief risk officer, the risk manager, and the rest of the organization need to be committed to the whole risk management strategy, of which one tiny piece is this captive thing. All right? That's all it is, okay? You know, when the risk manager at Genting spoke, it was all about risk management. It wasn't about his captive. That's just detail. So I think for me, the big takeaway, thank you very much. So.
You take 1.5 minutes to finish it off.
No, I have nothing to say, you know. Because anyway, thank you very much. Only 1 minute left. I think to be fair to Alan, thank you very much for giving us time. Since you are standing there, I don't want to say any more further.
I just
Other than
realized
saying thank you to our panelists. Thank you very much.
Thank you so much, Dato.